School Radio, KDKR, Decatur, Dallas, Fort Worth, KYJC, Commerce, and KMWC, Bethany. On the web at kdkr.org and on all your devices with the Live 365 app. Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
So what are the details of the big, beautiful bill? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, President Trump on July 4th, 2025, signed the big, beautiful bill, also known as the OBBB, which I think we'll stick with that today. The bill impacts taxes, healthcare, immigration, energy, and has created a lot of questions. Today, there's nobody better than IRS expert Dan Pilla to give us some insight and answers to those questions. Hey, Dan, always good to have you on.
It's always a pleasure to be on with you, Bob. How are you doing today?
I'm doing great. You know, what's interesting is it wasn't that long ago that we gave a breakdown of this on the radio, and I was thinking yesterday, we probably only scratched the surface because now people have got questions, and it's a real good timing to have you on the program to answer some of those questions. And I think of course the number one question is, how does this affect my income taxes?
Well, and the simple answer, Bob, is for most people, it's going to save a little bit of tax money because of some of the additional breaks that are available in the bill. But the biggest part of the big beautiful bill here, the BBB, if you will, let's just call it the Act. Let's just say that.
I like that. I like that.
I think they had a team of seventh graders that named this thing, Bob.
You think?
So for simplicity, let's just call it the Act. But the biggest thing it does, Bob, is it maintains in effect and makes permanent most of the tax cuts that were created in President Trump's first tax bill, which was the Tax Cuts and Jobs Act, which took effect in January of 2018. You might recall that the Tax Cuts and Jobs, and of course this was debated now for the last 8 years, is whether the Tax Cuts and Jobs Act was tax cuts for the rich or tax cuts for the middle class. The fact of the matter is it's demonstrably true that the vast majority of people that benefited from the Tax Cuts and Jobs Act are middle-class people, were middle-class people, are middle-class people, and the vast majority of the people that are going to benefit that are going to benefit from the Act here is, again, middle-class individuals, middle-class business owners, because to the extent that this bill makes permanent those Tax Cuts and Jobs Act reductions, then this stuff just flows through to more individuals. There's just no doubt about it.
You know, I wonder if people really have a good understanding, a good feel for how bad it would have been had this not passed.
Well, they don't have any idea because the media spent the entire 4 years of the Biden administration slamming the Tax Cuts and Jobs Act, and
yes.
In fact, most of the first Trump administration slamming the Tax Cuts and Jobs Act as tax cuts for the rich, and that's exactly what they did with the big beautiful bill as it was moving through Congress. You know, you had these pundits in these left-wing news outlets that were constantly saying that this was President Trump's gift to his billionaire buddies, and the only people that were going to benefit from this is his billionaire buddies, which just simply could not be further from the truth. It's demonstrably false that this act benefits primarily in any event, in any degree, benefits billionaires, Bob. The vast majority of these things are directly pointed at at middle-income Americans, for sure.
Okay, let's talk about a big one, tips and overtime. How are those taxed going forward?
Yeah, there's actually three elements of the bill here that I called Trump's big three proposals. and it was tax on tip income, overtime pay are two of the three. Social Security benefits were the other two. But getting specific to your question here, as far as tip income and overtime pay is concerned, there's a deduction that is now available that excludes a portion of this income. The argument that Trump used during the campaign, the presidential campaign, was that he was going to eliminate all taxes on tip income and overtime pay, and some of the news that's out there indicates that there's the elimination of tax on tip income and overtime pay, and that's not true. All right, so what happens is, with respect to tip income, you can exclude up to $25,000 of that income, all right, for year, and as to overtime pay, you can exclude up to $12,500, and that would be $25,000 for married filing jointly. So it's not all excluded. There's only a portion of it that is excluded, and frankly, both of these deductions phase out when adjusted gross income exceeds $150,000 for individuals. So here is even more evidence, Bob, that this bill does not constitute tax cuts for the rich, because all the benefits phase out for high-income people. All right, so again, to recap very quickly, you got $25,000 of tip income that's excluded, and $12,500 of overtime pay that's excluded. This is for individuals now.
Now, when you say tip income, is that any tip income? I mean, most of the time, I think people just think about restaurants, that sort of thing. But like a hairstylist gets a tip. Do they get the tax break?
Well, it's interesting because the law uses language that says in order to be excluded, the tips must be earned by the employee in occupations that customarily and regularly receive tips. So that would be service people primarily. Mm-hmm. All right, waiters and bartenders come to mind, people in the service industry. But I would argue that anybody that customarily, well, that's what the law says, anybody that customarily receives tips would be able to exclude those tips. Now, there are exceptions in the law, and that includes people in the legal business, healthcare, consulting, financial services, athletics, performing arts. These are exceptions that are built into the law. So in your example of a hairdresser or a stylist, those people customarily do receive tips, and they would be, I would argue that they would be excluded.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Talking to Dan Pilla about the act. I like that. And we're breaking it down, talking a little bit about trying not to confuse you, but to clear up some confusion. Dan, what about the new child tax credit amount?
Well, yeah. Again, this is not new. The child tax credit was doubled under the Tax Cuts and Jobs Act. In the big beautiful bill, it goes to $2,500, and that's through 2028. Now here's the thing, Bob. Let's get back to the tips and the overtime pay here for just a second, sure, because it ties to this. These are temporary benefits, all right? I mean, that's the good news is you got these exclusions. The bad news is they're temporary, all right? And so the overtime pay and the tip income, that is only effective for tax years 2025 through 2028, and then they just simply go away. And in the case of the child tax credit amount, it goes to $2,500 through 2028, but then it drops back to $2,200. And so you've got these limitations here that people need to be aware of.
This may be a Captain Obvious question, but why do they go through all this trouble to do these things and write them for 3 years and then they sunset?
All right. Do you want my cynical answer, or do you want the answer that they would that the policy folks in the Ways and Means Committee and the Senate Finance Committee would give you? Which answer do you want?
The cynical one, please.
Okay. The cynical answer is that that they make these things temporary. The Republicans, for example, make these tax cuts temporary so they can argue, like we saw in the last presidential election, that if you don't vote us back into office, all these benefits are going to expire and
right.
your tax liabilities are going to skyrocket. So it's a way to hold the taxpayers hostage to get votes again in the next election cycle. That's the cynical answer.
Yeah, makes sense.
Now, do you want the other answer?
Sure, why not? We're on a roll.
Why not? Okay, so the other answer that the policy analysts would give you from the Senate Finance Committee and the House Ways and Means Committee is they would say, well, in order to get everybody on board with these cuts, we had to make them temporary because the revenue loss has to be made up somewhere. All right, and so what we have to do is we got to make these things short term so that we can see what revenue generation occurs as a result of these things, and then we can reevaluate 3 years from now, 5 years from now, and make the tweaks and changes that are necessary to minimize the deficit that's created by the tax cuts. To which I say, B as in B, S as in S, because they don't give a rip about any of the deficits. If they did, we wouldn't have a $38 trillion national debt.
Very well said. How do you justify they look out and they said there's 4 to 5. It's going to create $4 to $5 trillion worth of debt. I just don't see how you can.
Well, yeah. And you got two different ways that this deficit creation or let's say addition, the deficit addition that's going to result from the bill. There's two ways that this can be looked at. One is through static analysis, and the other one is through dynamic analysis. All right. And so what happens is when you say we're going to cut taxes on $25,000 worth of overtime pay, right?
Right.
And let's see, did I get it mixed up? $12,500 worth of overtime pay, $25,000 worth of tip income, right? So we're going to exclude that. So what they do is they just do a simple math problem, and they say, okay, we're going to take X billions of dollars off the tax base, and so that's going to cost X billion dollars in lost revenue. Right, that's what they call static analysis. They just do the math and they say, okay, if we've got $10 billion less of tax base, and we would have collected, just pick a number, we would have collected $250 million in tax off that tax base, then we lose $250 million worth of revenue, and therefore the deficit goes up by $250 million. All right, that's just a simple math problem. It's called static analysis. All right, what dynamic analysis does is it evaluates the behavior of people. All right, and so responsible economists will tell you that when you reduce the taxes on certain behavior, you get more of that behavior. All right, and so you tax the behavior at a lesser rate, but you get more behavior, and so therefore you increase revenue as a result of that. So it is pretty well settled, Bob, that when you reduce the rate, you increase the revenue because now people have more incentive to produce. And it takes into account human nature. And I'll give you an example that'll prove this unequivocally, very simply. All right, let's just say our tax base is income, right? That's what the federal government collects most of its revenue on is income, right? So if our tax base is income and the tax rate is 0, how much tax would be collected?
I would think 0.
You would get 0. You'd get 0 revenue. If our rate is 0, you're going to get no revenue. All right, now, let's say our tax base is income, and the tax rate is 100%. We're going to tax at the rate of 100% every dollar you earn. How much money would be collected from that tax system?
100%.
Bob, look, think about this. Would you work for no money? Would you go to work every single day and produce, $50 or $100 or $200,000 a year to pay 100% of it to the federal government? Would you do that?
No, wouldn't do that.
No, nobody will do that. Nobody will show up for work if the tax rate is 100%. So if we have a tax rate of 0, we collect $0. If we have a tax rate of 100%, we collect $0. All right, and so that's dynamic analysis. So what we have to do, and the challenge for policymakers, tax policymakers, is to find that magic number somewhere between 0 and 100%, where you collect the most amount of money with the least amount of damage to the economy. All right, and typically speaking, these analysts, particularly the Marxist analysts, they don't ever take into consideration dynamic analysis, because their goal is to transfer all the wealth to the government anyway.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you want more information about Dan, taxhelponline.com is where you go. Let's talk a little bit about those who are receiving Social Security. And of course, this was advertised and marketed as a tax-free benefit going forward, but that's really not what's going on. Talk a little bit about what senior citizens are to expect and really what ends up happening.
Yeah, well, first of all, it's not even close to what was advertised, all right? What was advertised is that they were going to eliminate taxes on all Social Security benefits, just simply exclude them from taxation, and that's not at all what happened. So what happened here instead is that citizens age 65 or older are allowed an additional $6,000 for individuals, $12,000 for married filing jointly, as a standard deduction. All right, and this standard deduction is allowed even if you itemize your deduction. So this is an additional exclusion from income of up to $12,000 if you're 65 years of age or older. All right, but how? But the problem. But again, Bob, this is temporary. Also, this applies only for tax years 2025 through 2028, and it phases out, and it phases out faster than the other breaks did. The exclusion for tip income and overtime pay. So when we're talking about the phase out for the Social Security benefit here for the additional $6,000 deduction, that phases out if your income is more than $75,000 for an individual, or $150,000 for joint filers. So there's a lot of Social Security recipients that earn less than $75,000 a year. There's no doubt about that. But anybody 65 years of age or older earning more than $75,000 a year just isn't going to get the benefit, Bob.
Unfortunately, I think this ends up being extremely confusing for those taking Social Security and kind of leaving the thought that, well, this is a permanent tax break when it's not even close.
Yeah, it's not even close. And not only is it not permanent, it just simply isn't going to apply to everybody. It just isn't. Let me ask you this question. You might know this better than I do, given the business that you're in. Do you have any idea what percentage of Social Security recipients, what percentage of citizens age 65 or older make more than $75,000 a year as an individual? Do you have any clue?
Oh, I would think it would be incredibly low. I mean, 1, 2, 3%. If you're looking
you
at
think it's that low, huh?
I do think it is.
Okay, and you very well could be right, and this is something we could easily research and find out. I haven't bothered to do it, but so the bottom line is it's going to help a lot of people, no doubt about that, but it is not a permanent and across the board exclusion of tax on your Social Security income. It just isn't.
Okay, this one leaves me scratching my head. Trump accounts for kids.
Yeah. Well, well, first of all, I'm in the process of doing a pretty detailed article on the Trump account for kids.
Really?
Yeah, and what it does is it's really an odd thing. It allows you to give up to the Trump account allows up to $5,000 a year to be deposited in a tax-exempt savings account. All right, this is what they're calling the Trump account. The account is intended to provide a foundation of security for young people. All right, it starts the saving process for young people at a very early age. And what the attractiveness is. What the attractiveness of this is right now is there is a one-time credit of $1,000 that, in other words, the government will give you a tax credit of $1,000 for each child named on a Trump account for those kids that are born between 2024 and 2029. So young kids here we're talking about. And so the parents of the child manage the account on behalf of the child. The child is eligible to withdraw the money later on in life. And so this tax exempt account grows, and you know, that's basically it in a nutshell, Bob. It's not that much different than an IRA or a 401k, except the money you put into the account is not deductible. All right, so that's a key. You can't deduct the income, the contributions to the account on the tax return. It's just simply a vehicle to provide tax exempt savings to children. And again, the idea here, the attractiveness here on the front end is that $1,000 credit that's available right away.
Well, so what in general what do you think about this?
I don't know. It's certainly a way to save money for young children. The difference between that and a 529 account, from what I can see here early on, is the 529 account has to be used for education, as I understand it. Mm-hmm. And this doesn't. It can be used for anything once the kid is eligible to take the money. And I think the eligibility age is 21, although I got to confirm that. But, at some point, from what I understand, they can take the adult, if you want to call 21-year-old adult, can take that money and do whatever they want to with it. There's no controls over it at all. Yeah, that's exactly right. There's no limitation on what they can do with it. There's no withdrawal penalty on it if they take it after they're an adult. Of course, it's income at the time they take it, but the idea is it's tax deferred all these years, right? It's tax deferred all these years as the money is building up. In that sense, it's very much like a 401k or an IRA. You don't pay tax on the gains on the account as they occur, but when you take the money during retirement, it's considered ordinary income as you take the distribution. And this will work the same way. The big key here for parents with young children right now is the $1,000 tax credit, right? So you open up this account for the kid, the government gives you you get a $1,000 tax credit, which is basically a $1,000 gift from the government, Bob, is what it amounts to. It's free money from the government. Right. What's better than free money from the government, Bob? Nothing.
Free money from the government.
Yeah, great. It's great. No one ever has to pay it.
Tax Help Online is Dan's site if you want information about how to deal with the IRS. If there's an article about it, he's written a book about it. And he's got all of his resources there at the site, taxhelponline.com. We've got about a couple of minutes left, and I thought a great one to bring up would be the car loan interest being deductible. I know there's a lot of fine print to that.
Well, yeah. First of all, there's a limitation on it to start with. There's a limitation on all this stuff, obviously. And so what you can do under this new deduction is you can deduct a interest on a personal automobile loan up to $10,000. All right, and so the limitation again is this applies only for tax years 2025 through 2028. All right, so it phases out during that after 2028 it's gone. It phases out during that period of time. All right, so it's not available for anybody making $100,000 a year individually or $200,000 a year for joint income. It can only apply to an automobile. It's not available for campers or motorhomes or anything like that. And so it's got to be based on U.S.-made automobiles, Bob. That's the other thing, or actually assembled, not necessarily made, but assembled in the United States. So it's a limitation, and you know, it's an itemized deduction, so it's not available to somebody that has a standard deduction on their tax return. You got to itemize.
So we have a lot more to talk about, and not much time left. So we'll probably have to revisit this just real quick. I got about a half a minute. Do you feel like they missed an opportunity to really do something? And I'm going back to this to Social Security. I mean, this is a program that needs to be fixed.
Well, here's what the problem is, Bob. Yes, you're right. They did miss an opportunity, but here's the thing that's controlling the debate, and that is they will not consider spending cuts. And as long as they will not consider spending cuts, all of these tax cuts have to be extremely limited, because the philosophy is we need the money, we need the money, we need the money, and they will not give up the spending. That's where the restriction is. That's where the problem is.
So your next newsletter is going to be talking about Trump accounts.
Yeah, I'll have a detailed article on it with
we'll have to cover that next month.
All the ins and outs. We'll talk about that next time.
TaxHelpOnline.com is the site. Dan Pilla is the expert. Dan, thank you for coming on the program.
My pleasure, Bob. Thanks for having me.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know, it's just there's so much packed into this bill, and just hope that people get some clarity on really how it works. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.